Hello and welcome to Session 15 of the Basic Tax course. We're going to begin Session 15 with a review of the Session 14 quiz answer key, and we're going to begin with question number 4. In 2010, you bought 100 shares of XYZ stock for $1,000 or $10 per share. Then in 2011, you bought 100 shares of XYZ stock for $1,600 or $16 a share. In 2012, XYZ declared a 2-for-1 split, and which of the following choices is correct? And essentially what you have to do when you're looking at this problem is remember that a 2-for-1 split means you're going to have twice as many shares for half as much cost. So we begin by looking at the first set of stock, which is 100 shares, followed by another 100 shares. And so if we've had a 2-for-1 split in 2012, which is clearly following years where stock was purchased, we're now going to have 200 shares of XYZ stock that cost $1,000. But 200 into 1,000 is going to give us $5 a share. And we're also going to have 200 shares of XYZ stock at a cost of $1,600 or $8 a share. And so when we look at the options, we now have 200 shares with a basis of $5, or we have 200 shares with a basis of $8 per share, or 400 shares with a basis of $6.50 per share. Which of these is the correct answer? Well, the reality is that it's D, because both A and B are true. 6. Several years ago, Naya paid $160,000 to have her home built on a lot that cost her $10,000. Before changing the property rental use last year, she paid $20,000 for permanent improvements to the house and claimed a $2,000 casualty deduction for damage to the house. On the date of the change in use, her property had a fair market value of $180,000, of which $30,000 is for the land and $150,000 is for the house. Her depreciable basis for the house is, and you can see $150,000 is the correct answer. But let's go into the meat of the problem here. The actual construction cost of the house is $160,000 plus $20,000. So it would appear on the surface that her basis in the house is $160 plus $20 minus that casualty loss of $2. But in fact, when it comes to placing property in service, you must claim the lesser of your actual cost basis or the fair market value on the date that the property is converted to business use. And in this case, the lesser of those two numbers, her actual cost basis or the fair market value, is $150,000. Fair market value is the lesser number, and so that, as a consequence, is the depreciable basis in the house. Question number 7. John and Fred owned, as joint tenants with right of survivorship, business property that they purchased for $40,000. John purchased 1/4 of the purchase price, and Fred furnished 3/4 of the purchase price. Depreciation deductions allowed before Fred's death were $8,000. Under local law, each had 1/2 interest in income from the property. At the time of Fred's death, the fair market value of the property was $80,000, and 3/4 of that is includable in Fred's estate. What is John's basis in the property at the date of death? So in looking at this, we have to look to what it means for joint survivorship and how stepped-up basis works on death. Firstly, let's look at the consideration of stepped-up basis on death. On death, the value of the property is assessed, and whatever that value of the property is on the date of death, that becomes the basis for whoever acquires the property at death or inherits the property. In this case, right of survivorship means that Fred's share of business has been inherited by John. So John now has a basis in Fred's share of the property that is equal to the fair market value of Fred's share of the property on the date of his death. So we begin by looking at what was the fair market value of the property on the date of death, and you would take 75% of $80,000. And you can see here, if we look at the answer key, question number 7, it says, John's basis is calculated as follows. His original basis is $10,000, which is 25% of $40,000. We're then going to look at the amount that he inherits from Fred on Fred's death. And since the entire value of the property on the date Fred died is $80,000, we're going to multiply $80,000 by the 75% interest that was owned by Fred. And that's going to give us the portion of the property that is Fred's basis. So continuing with the calculations going into John's basis, we take a look at the basis in the inherited portion of Fred's share of the business. The inherited basis is $60,000. So the basis in 75% of the business is $60,000. But the remaining 25% of the business was not inherited. And so for the remaining 25% of the business, we go solely to John's original cost. Well, his original cost was $10,000. And in the wording of the problem, we tell you that he has claimed $4,000 of depreciation. And so we're going to take the $60,000 basis that is the inherited portion of the basis. And to that, we're going to add $10,000, which is his original basis. And then from that, we're going to subtract out $4,000 of depreciation that is attributable to to John's share of the business for the period of time that he has been an owner of that 25% share. So once you do that calculation of $60,000 plus $10,000 minus $4,000, you get a basis of $66,000. Now, one question that may be popping into your mind is, how exactly do we get this depreciation percentage of $4,000 or this depreciation portion of $4,000 when we tell you in the wording of the problem that $8,000 is for all of the depreciation and John is only a 25% owner? Doesn't it make sense that his share of the depreciation would be $2,000 rather than $4,000? So let's just read through this problem and kind of clarify that. Firstly, the original cost in the property is $40,000. But that's in terms of the cost of the property, how much was paid for the property. The second sentence in the problem states that the income of the business is going to be split 50-50. So even though there's a cost basis difference in the two partners, the income split is equal. So when depreciation deductions are claimed, they are claimed equally. And so those depreciation deductions are equally split, and that means that even though John only owns 25% of the property, he owns 50% of any depreciation claimed by the business. And so we end up with him having $4,000 of depreciation. So again, we calculate cost basis by looking at John's original cost of $10,000. He gets 50% of the $4,000 of depreciation claimed, and that reduces his basis down to $6,000. He then inherits $60,000 of business property on Fred's death, and that means that $6,000 plus $60,000 gives you a cost basis of $66,000. Moving on to question number 8. Sue sold land to her brother Sam for $6,000. Her basis in the land was $7,000. She cannot deduct the $1,000 loss. Sam sold the same land to an unrelated party for $5,500, realizing a loss of $500. How much of the loss can Sam deduct? And you can see that the answer here is $500. Just going over the answer key, you can see that if you sell or trade at a loss property that you acquired from a related party, you cannot recognize all of the loss that was not allowed. You cannot recognize the loss that was not allowed to the related party. So if there's some question in here that could Sam somehow claim a deduction for the loss that goes all the way back to Sue's original basis, the answer is no. He only looks to what he paid her, and he's allowed that loss of $500. Question number 11. Joe exchanged his pickup truck with an adjusted basis of $8,000 for a new truck with a fair market value of $7,000 and cash of $2,000. Both trucks are used in his business. What gain, if any, must Joe recognize, and what is his basis in the new truck? His adjusted basis in the old pickup truck was $8,000. When he trades it in, he gets a new truck costing $7,000 and $2,000 back in cash. In effect, what that means is that he has been given $2,000 in cash with a basis of $8,000 and property of $7,000. Or you could say that 7 plus 2 is 9. He's getting $9,000 worth of property for a vehicle that was worth $8,000 in terms of his cost basis. So somewhere in there, he's making money. He's got $1,000 of cash that he's keeping in this deal. And so that $1,000 of cash becomes a profit to him, a taxable gain that he must realize on the like-kind exchange. And after he realizes a $1,000 gain on this $9,000 that was provided to him in the transaction, that means his remaining cost in that transaction is going to be the remaining cost basis in the vehicle. And since the vehicle is worth $7,000 and he was given $2,000 in cash, he can't really say that the $2,000 of cash is living in the basis of the vehicle, because it's not. But not all of the $2,000 is taxable either. He's got 7 plus 2 from 8. That gives a profit of $1,000. That $1,000 is taxed, and then the remaining basis in the vehicle is $7,000. So that makes 11D the correct answer. And if you just want to see the kind of legalese behind it, we call this a partially taxable exchange because the basis of the property you receive is adjusted by, let's read this again. This is a partially non-taxable exchange in which the basis of the property you receive is the same as a basis of the property you give up, with the following adjustments. Number 1, you decrease the basis by the following amounts: any money you receive and any loss you recognize on the sale. Well, there was no loss on the sale, but there was money received. So we'd have to reduce the basis by the money that was received, and we have to increase the basis by any gain that you recognize on the sale. So we begin by taking 8 and subtracting 2, because 2 is the money received, but then we have to recognize a $1,000 gain, so that $1,000 gain is added back into the basis, and that's where we get $7,000 again. Moving on now to question number 19. Kieran bought stock in the Big Bang Corporation in 2007 for $2,000. Then in 2011, Kieran received a return of capital distribution of $100 as a partial return on her investment. In 2012, Kieran sold the stock for $3,000. Her basis in the stock is, this is actually a pretty easy one. We look at the original cost basis of $2,000, and then we remember that when we receive a capital gain distribution that is a return of capital, that distribution is not taxable, but it does reduce basis. So $2,000 minus $100 is $1,900, and $1,900 becomes her basis. And what she sells it for doesn't affect her basis. It would help you calculate her gain. So $3,000 minus $1,900 would give you a gain of $1,100, but the question isn't asking you what the gain is, it's asking you what the basis is. So that concludes this review of the Session 14 quiz answer key. Let's now begin with the Session 15 lecture. Thank you, and welcome to Pacific Northwest Tax School's presentation of Depreciation Made Easy. Now, you may have heard me mention in earlier classes that depreciation is my personal favorite topic. And you might think that's a little bit odd, so I'll explain why. Well, it happens to be that although I've got a really good mind for tax and a really good ability to retain information and remember it, I'm not so good exactly with numbers. In other words, I don't have this number awareness. Some people see a number, they can do a mathematical calculation in their head quite easily and see that something doesn't quite add up. Well, that's not me. And so when it comes to numbers, I have to study them very carefully and very hard. And when I first started taking tax law and it came to depreciation, my mind went into overload. And the reason it went into overload is that the course required us to use depreciation tables to figure depreciation. And I was preparing for Oregon's tax preparer exam at that time, and I somehow thought I was going to have to memorize those tables. I don't know why I thought that, but I did. And I said, well, that's just impossible. I can't memorize tables. So right then and there, and this is over 20 years ago now, I sat down and figured out how the numbers on the tables came to be. In other words, I did a bunch of calculations backwards to finally figure out how we come up with the numbers that go on the tables, because my reasoning was, well, then I wouldn't need the tables. And as a result of that effort, I've always found depreciation easy. So although it's something that should have scared me and did scare me early on, from that very first point when I figured out how it all works and comes together, it became easy. And so I'll teach you depreciation the way I taught it to myself. And hopefully you'll walk away today saying, oh, depreciation is easy. So let's get going. So of course the starting point of today's class is IRS reading assignments. And the information you see in the manual that I have in front of you all comes from these publications. And we have IRS Publication 946, How to Depreciate Property, Instructions for Form 4562, IRS Publication 535 on business expenses. In particular, we want you to look at Chapter 8, which covers amortization, because although IRS Publication 946 is a very lengthy publication with all kinds of really fascinating information in it, it doesn't talk about amortization at all. And when you get to 4562, which is the form you claim depreciation on, well, there is a section for amortization. So the instructions for Form 4562 do give a little bit of information on how to complete that amortization section. But to learn more, then you need to actually go to Publication 535. And the last reading assignment on the list is the Department of Treasury Memorandum for Industry Directors. This is a publication or an opinion that was released by the IRS way back in 2003, and it applies specifically to the restaurant industry. And the restaurant industry obviously has a lot of different kinds of equipment that are used in it, and the treatment of some of those types of equipment is different under depreciation life than it is for other kinds of property used in other kinds of business, or the same kind of property perhaps used in another kind of business. So therefore, that reading link is in there for you. Inclusion. If you've ever heard about something called inclusion, Travel and Entertainment Publication 463 is where you go and learn about inclusion amount. All right, so here we are with the introduction of today's class, and I'm just going to kind of give you a little bit of a background on depreciation and also mention something that the IRS is working on right now, just as a kind of an offshoot, but then we'll get into the meat of the matter. So if you use your property in your business, you generally cannot treat the cost of the property as an expense. Instead, you must recover the cost of property each year based on each asset's expected useful life. This system of claiming the cost of property over its expected useful life is called depreciation, except when it's amortization, because the cost of certain intangible assets is recovered through something called amortization rather than depreciation. Now, the expected useful life for each depreciable class of asset is shown in Appendix B of IRS Publication 946. And I think it's never too early to actually open up and show you Publication 946. So I'm going to do that right now. Publication 946 is one of my favorite publications because I use it all the time, and it's one of the few publications I'll actually order from the IRS so they can have it on a shelf and handy next to me if I need it. And you can see that when we get into Publication 946, it describes what kind of property can be depreciated, when does depreciation begin and end, how do you treat repairs and improvements. Then it goes on electing the Section 179 deduction, claiming the special depreciation allowance, figuring depreciation under MACRS, Chapter 5, additional rules for listed property, and it goes on from there, page after page. This publication is 114 pages long, so it makes it one of the longer ones out there. Now, if we get down to the very back of the publication, I'm just going to randomly pick page 110. Oh, there's the index, which is always helpful. But before that, there's what I'm looking for. We're looking for the class tables and lives and recovery periods. And so I'm going to be referring to this particular table throughout today's class, just getting to the very beginning of it. So the table inside Publication 946 begins on page 99 of the publication. And another point to make out to you today is we're going to be doing a lot of figuring in today's class. This is not just like a passive class where you sit back and you're going to learn depreciation because you sat and listened to me talk for 6 hours. It doesn't work that way. The way you're going to learn depreciation is by doing. So if you haven't already got a calculator handy, as soon as you are able to get a calculator handy, I would recommend that because we're going to be doing lots of working exercises today. And one of the exercises we'll have, or all of the exercises we'll have, are going to require that you do computations that involve the useful life of an asset, and how you figure out what the useful life of an asset is in the appendices for 946. And in this case, it's table B1. And all of the assets are listed here. So we're going to come back to this in a little bit. And for now, back into the body of the manual. So the expected useful life of each depreciable class of asset that you might ever want to know about is in Appendix B or Table B of IRS Publication 946. And then the amortizable life of assets is not discussed in 946 at all. Instead, you're going to have to go to IRS Publication 535 if you want to figure out the useful life of amortizable property. But in most cases, that's 15 years and easy to remember. Now, I did have a student comment or question me several months ago about IRS bulletin that had been released on certain changes that IRS is making to its interpretation of depreciation. And so I thought, I'll just put a little bit in the class today about what that bulletin said. However, for the most part, it entails absolutely no change to the law. It's just IRS clarifying how it interprets the law. And it really then only affects larger companies with very proper systems of accounting put in place. And your typical small business owner probably lacks the formality or the need of those types of accounting systems. But nonetheless, I'll let you know what the bulletin was about. It has to do with deduction and capitalization of expenditures related to tangible property. And that's a long sentence that is essentially saying, are you allowed to claim a deduction for a tangible asset that you purchased? Or do you have to capitalize it? And if you capitalize it, then if you are allowed to claim any deductions, those are through depreciation. So the entire title of this heading, what it means is, I've gone out and I've purchased something. Do I have to capitalize it, or can I expense it? And sometimes it's not quite so easy to know the answer to that question. And especially when you've got very large businesses that are spending millions of dollars a year on stuff, just trucks, trains, boats, computer equipment, desks, hat holders, coat holders, supplies for around the office. You can just imagine how much money a large business would spend on stuff. And I run a small business, and the amount of money we spend on stuff is inordinate. And so how do you sort through all of that and make a decision about when you purchased something that can be expensed as a supply type item or a consumable item, as opposed to spending money on an asset that cannot be expensed except through depreciation or through the Section 179 deduction, which is a part of depreciation? So because there has been some argument or discussion, probably a lot of it over time, about when an item should be expendable and when it needs to be capitalized, the IRS is working on clarifying that. And so it's still not done. They're still working on it, but sometime this year they're going to release their final opinion. And I'll just explain to you where they're sitting right now. So the IRS released Internal Revenue Bulletin 2012-14, and in it, it provided some guidance regarding deduction and capitalization of expenditures related to tangible property. The bulletin itself was quite lengthy. It was quite something to read through it. And it was released over a year ago now, so a year later they're still working on the concept and coming up with their finalized procedures. But the guidance they released in April is intended to help businesses establish whether or not expenditures can be capitalized or deducted as expense items, and for the most part, it is not a change in the law, but rather an attempt to help clarify existing law. In 2013, the IRS has said it is expected to publish final regulations on the tax treatment of amounts paid to acquire, produce, or improve tangible property under Sections 162 and 263A, and on the accounting for and disposition of property subject to Section 168. The final regulations will apply to taxable years beginning after January 1, 2014. However, taxpayers will be permitted to apply the provisions of these final regulations to taxable years beginning after January 1, 2012. So right now we're in a transition phase where it's permissible to not use the new procedures, and it's also permissible to use the new procedures. You just need to make a decision about what you're going to do. Now, what is the effect of the regulations? The new regulations will have limited impact on most small businesses. However, larger businesses whose current accounting methods do not comply with the final regulations will need to modify their method of accounting for tax purposes. The following Internal Revenue Code sections are being modified to reflect the final regulations, which will be announced in 2013. They include the de minimis rule, dispositions, and the safe harbor for routine maintenance. The de minimis rule would allow certain businesses with formalized accounting systems and financial statements to claim an expense deduction for the cost of certain assets, which must normally be capitalized if the cost of the assets meets the de minimis rules. Disposition reporting requirements are being tightened. MACRS assets that are removed from service, sold, or otherwise disposed of are subject to specific reporting requirements. The IRS is clarifying these reporting requirements and their tax treatments. Well, when you dispose of a MACRS asset that was used in your trade or business, that is an asset that the disposition needs to be reported, and it's reported on Form 4797. So really, when IRS gets into clarifying the rules for dispositions, we can probably be expecting some clarification or additions to reporting requirements for Form 4797. That's what I'm expecting. At any rate, the rule is and always has been that when you sell a business use asset, then it is supposed to be reported on 4797. So what they're going to clarify there remains to be seen. At least for me, there's probably people who know what is coming. I just don't. And then we have safe harbor for routine maintenance. A new provision will provide a safe harbor for routine maintenance. The proposed new regulations make it easier for businesses to determine if the cost of assets acquired to maintain property can be expensed or must be capitalized. Now, accounting method changes may be required, and larger businesses may be forced to implement significant changes to their accounting methods to comply with the new regulations. And they may be required to file IRS Form 3115 for a change in accounting method to account for income reporting differences that result from these changes. CCH issued a tax briefing 30 pages long which analyzes the proposed regulations, and a link to that CCH publication is located here in the manual. Now, you could click on it in the computer screen while I'm talking, but that's not what I'm suggesting you do. What I'm suggesting is that after today's class is over, you can return to Open Campus, that's Pacific Northwest Tax School's Learning Management System. If you have not already printed the manual or found the manual in there is a manual in there for you, and you can just save that manual to your desktop somewhere. And then anytime you want to reference some of the links that I've inserted in the manual, you just need to open the manual and go to the page, and then you can click on this link and it will actually take you to CCH's summary, which is a very nice thing to have found because the IRS bulletin was a lot longer than 30 pages and a lot harder to read. So CCH did a good job. And what that document does, that CCH published, is provides a very good summary of the types of accounting changes that some businesses may be required to implement. I'm not going to talk about those. Today's class is on depreciation and not on changes in accounting methods, but if you're curious about them, I would recommend you look at that CCH publication. There is limited impact for small business as a result of these changes. Most small businesses will see limited effect from the regulations. For example, the proposed de minimis rule currently applies only to businesses that meet the following tests. Number one, the taxpayer has an applicable financial statement. 2, the taxpayer has, at the beginning of the tax year, written accounting procedures treating an expense for non-tax purposes, the amounts paid or incurred for property costing less than a certain dollar amount. The taxpayer treats the amounts paid or incurred during the tax year as an expense on its applicable financial statement in accordance with its written procedures, and the total aggregate amounts paid or incurred and not capitalized under the de minimis rule, including materials and supplies for which an election is made to apply the de minimis rule, are less than or equal to the greater of 1% of the taxpayer's gross receipts for the year as determined for federal income tax purposes, or 2% of the taxpayer's total depreciation and amortization expense for the tax year determined in its applicable financial statement. Well, that's a mouthful, but what it essentially says that you must already be interpreting is that most small businesses, they're lucky to have a financial system in place at all. If you're talking, mom and pop stores, usually their financial records are not the greatest, and even if they are, it's unlikely that they're going to meet those standards. So de minimis, the whole point of de minimis is that you would be able to purchase certain assets that have an anticipated useful life that exceeds a year and normally would need to be capitalized, but because the amount is de minimis, you can write it off instead of capitalizing it. And in order to be able to do that, you have to apply all of those de minimis rules, and most small businesses can't approach those. But then again, they don't need to, quite frankly, because if you're not at all sure whether an asset qualifies as an expense or whether it should be depreciated, we still have the Section 179 deduction, which is plenty for most small business owners. And if there's any doubt, they just put it on the depreciation schedule, expense it out through 179, and they're good to go. So small businesses that do not maintain financial statements and other required records will not be eligible to use that de minimis method. And until the final regulations are published, IRS may make further changes to the proposed revenue procedures. So with that introduction, let's take a look at a couple of definitions that you really do need to understand. The IRS classifies property as either tangible or intangible. Tangible property is property that you can see and touch. Examples of a tangible property include land and buildings, cars, TVs, clothes, etc. And there are two types of tangible property: real property and personal property. Real property is as it sounds. It includes real estate, and that is land, buildings, and generally anything built on land, growing on land, or attached to the land. Personal property includes everything else: cars, trucks, machinery, furniture, your pet dog, your pet horse, your CD collection. That's all personal property, and it's tangible. You can see it and you can touch it. Intangible property is property that has value but cannot be seen or touched, or that it's difficult to really perceive it as you would a normal tangible object. And examples include patents, copyrights, goodwill, and the going concern value of a workforce in place. So let's talk about those two concepts for a minute. Let's first look at goodwill. If you were to purchase a business, you would probably be purchasing the business because it has something of value. It might have some furniture and equipment on the site, but you could go out and buy that yourself. So why are you buying it from an existing business? Well, you might want to buy it because that business is in a good location and it has a customer base coming in. And that customer base is happy with doing business there. And that's what goodwill is the retention or the purchase of a client base, in so many words. Now, going concern value, that's the fact that you're not having to get this business all going on your own. Someone's already done all of that work. It has a workforce in place, people who are trained and know what their jobs are. There's systems in place, procedures in place to make the business operate efficiently. All of that has extreme value, but it's intangible. It's difficult to put a finger on it. It's difficult to describe it. You can certainly see it when you go in there. You can see that it's a business. You can see there's people running around. You can see customers are coming and going, but it's still considered to be intangible. So what is the difference between depreciation and amortization? Well, generally you depreciate tangible property and you amortize intangible property. So let's look at depreciation then. Depreciation allows you to claim a deduction for the loss in value of an item because of wear and tear, age, or other cause. Under the Internal Revenue Code, there are a number of different depreciation recovery methods that allow you to claim a deduction for the loss in value of an asset. Depreciation is used on tangible property. However, prior to August 11, 1993, you could amortize or depreciate intangible property. Amortization, by comparison, allows you to claim a deduction for the cost of an item over its projected useful life, and since August 11, 1993, the law requires the cost of intangible property be amortized rather than depreciated. Amortization is always straight line, and the allowed recovery period for most intangible property is spelled out in the IRS regulations. In general, most intangible property is amortized over a 15-year period. However, prior to October 23, 2004, certain costs, including business startup costs, could be amortized over 60 months instead. So we're going to be spending most of today's class talking about depreciation, and when we're all finished with depreciation and how you calculate depreciation, all the rules for depreciation, then we're going to go over to amortization and talk about it. So we're on to depreciation, and this is what we have to say. The cost of property that has a useful life of more than 1 year is not considered to be an expense to a business. This is because the property continues to have value over time, and depreciation is the method used to recover the cost of most tangible property. So what does that sentence mean? Well, if you go out and you purchase a computer, you'll certainly notice the hole in your wallet when you've done that. You've just spent $2,000 on a computer. You don't have that $2,000 anymore. You have a computer. So it's certainly easy to see how that would be an expense. But you have a computer. You could put it on eBay. You could return it to the store where you purchased it and get your money back. You could use it for a year and then sell it. Even after a year, it's still going to be worth something. Certainly not what you paid for it, but it's going to be worth something. And that computer is going to be able to assist you in your business, reasonably speaking, probably 5 years. And so that's why it's not considered to be an expense, because it continues to have value over time. So the way you recover the cost of that computer is through depreciation. And who can claim depreciation? Well, you can claim depreciation for most tangible assets used in your business or for rental purposes. Property used in any of the following ways is considered to be property used for business: rental property, self-employment, partnership, S corporation, farming, and employee business expense. How you depreciate property depends on the type of property you are using for your business. Some of the more common types of property used for income production in a business include land, buildings, furniture and office equipment, cars and trucks, heavy machinery such as bulldozers, tractor trailers, assembly lines, etc. Farm animals held for production of income, such as milk-producing cows and breeding animals, etc. Computers and peripherals. Improvements to property such as roads, bridges, landscaping, room additions, or other improvements to building. Note, however, that the following assets are never depreciable. An asset that has a useful life of 1 year or less, an asset that is placed into service and then taken out of service in the same year, or land. So if any of these applies to the asset you're considering, it is not depreciable. The next topic is depreciation systems. And the law does not allow you to claim depreciable assets as an expense, as we've been saying, and this is because the asset continues to have value for more than 1 year and has value over time. If your business property has a useful life of more than 1 year, you must generally spread the cost of the property over the assigned useful life of the property. Assigned useful life determines the rate at which the cost of property can be recovered, and the following depreciation systems have been used to recover the cost of depreciation. Firstly, we have the pre-1981 depreciation, and pre-1981 would be pre-Reagan, because there were some big changes that came in during Reagan's first term, and they started in 1981. Prior to 1981, businesses were allowed to depreciate property over its expected useful life, and this meant that the business, rather than the IRS, would determine the useful life of business property and depreciate it accordingly. As you might imagine, different businesses would apply different lives to the same kind of property. Depreciation systems used prior to 1981 included useful lives, straight line, or accelerated method of depreciation such as the declining balance method. Property placed in service before 1981 is referred to as non-recovery property. Well, then Reagan came in and we got a new system of formalized depreciation set in place called ACRS. It's called the Accelerated Cost Recovery System, ACRS for short. Beginning in 1981, the government assigned a useful life to the different types of property used in a business and created a standardized system for calculating depreciation called ACRS. ACRS rules apply to assets placed in service after 1980, but before 1987. ACRS worked so well that they decided to spruce it up a bit, and in 1987 they introduced MACRS, the Modified Accelerated Cost Recovery System. With MACRS, the government modified the assigned useful life of business property and introduced a new system for calculating depreciation. MACRS applies to assets placed in service after 1986, and since MACRS has now been in use for 25 years, most assets currently being depreciated fall under the MACRS rules. If you are depreciating an asset placed in service before 1987, you don't use MACRS. It's likely going to fall under ACRS or non-recovery property rules in play before that. And what's likely the case is if the asset was placed in service before 1987, it's probably fully depreciated. It's possible that it isn't, but it's likely that it is. The longest recovery period in place under ACRS, for example, was real estate at 20 years, and we're more than 20 years past 1986. So if anyone was using ACRS, the assets should be fully depreciated. Recovery periods. The recovery period of property is the number of years over which you are allowed to recover the cost of your asset through depreciation. There are two recovery systems: GDS, which is the General Depreciation System, and ADS, which is the Alternative Depreciation System. Here we have recovery periods under ADS, and in the next box we have recovery periods under GDS. Most of the time when we're working on depreciating assets, we're operating under the General Depreciation System, and so we would refer to these lives. You can see that 3-year property is 3 years, 5-year property is 5 years, 7 is 7, 10 is 10, 15 is 15, 20 is 20, 25 is 25, residential rental property is 27.5 years, and non-residential rental property is 39 years. If you don't qualify for GDS, then you typically will fall under ADS. And under ADS, things are not quite as friendly. 3-year property is still 3-year, and 5-year property is still 5-year property, but 7-year property has to be depreciated over 10 years, 10-year property over 20 years, 50-year property over 20 years, 20-year property over 25 years, 25-year property is depreciated over 50 years, residential rental property is depreciated over 40 years, as is non-residential rental property, and personal property with no class life assigned to it is depreciated over 12 years. So let's talk about ADS first. For most businesses, GDS is the depreciation system that must be used. Not necessarily must be used, but is the system that is used because it's the default system. If you don't think about it, you don't tell your computer to do ADS, odds are it's going to do GDS. It's just really the automatic system in place. However, ADS is required in certain situations. You are required to use ADS for the following types of property. Listed property used 50% or less for business, any tax-exempt use property, tangible property used predominantly outside of the United States. So for example, if you have a business operating in a foreign country or you own rental property in a foreign country, then you would have assets that are depreciable, but they're located outside of the United States. And if they're located outside of the United States, you cannot use GDS, you must use ADS. The alternative depreciation system must also be used for all property used predominantly in a farming business and placed in service in any year in which an election not to apply the Uniform Capitalization Rules was made. IRC, or Internal Revenue Code 168, provides in general that any tangible property used predominantly outside of the United States during the year shall be depreciated under the alternative depreciation system as follows. The method must be straight line without regard to the salvage value, and the recovery period is determined using the following table. Property type, recovery period, personal property is 12-year property, non-residential real and residential property is 40 years, and any railroad grading or tunnel bore is 50 years. If you're not working with someone in the railroad industry, you're looking at real estate being 40 years and everything else being 12 years. So it's actually kind of simple. So when can I choose to use alternative depreciation system? Even if you qualify for GDS, you could elect to use ADS. The election must generally cover all property in the same property class that you placed in service during the year. However, residential rental and non-residential rental property can be made on a property-by-property basis. Once you make the election to depreciate an asset using ADS, you can never revoke it. Well, when can I use GDS? Most assets used in a trade or business that are not listed property used 50% or less will qualify for GDS. And when we get into GDS, well, we're really talking about MACRS. MACRS is where we're going to be spending a good deal of our time today. When you have a discussion with a client about a depreciation system, odds are you're having a discussion about MACRS, and we're going to be learning all of the different rules that go into computing depreciation deductions under MACRS starting now. The U.S. government has set a standardized useful life and recovery period for most assets. I showed it to you already. It's Appendix B of IRS Publication 946, pages 99 through 108. It shows asset classes and their assigned useful lives. In general, if an asset has not otherwise been assigned a useful life, it shall be given a 7-year life under MACRS and 12 years under ADS. I have a copy of Appendix B at the back of this manual, and it starts on page 74. So I'm just going to pop over there and pull it up on the screen. I could go back to Publication 946, but we've inserted them into the manual for you. So if you have printed the manual or you've got it on your desktop, you have this information in front of you. So let's take a look at it a little more closely. And we can see that it starts with the asset class in the left-hand column. Then it provides a description of assets that belong to that class. Then it shows the class life in years. It shows the depreciable life under the general depreciation system, and it shows the depreciable life under the alternative depreciation system. So we've already learned some important definitions today, GDS and MACRS versus ADS. So you should already have enough information to know which column you would be referring to when you're preparing a client's tax return. We then go over to the asset class, and let's just take a look at a few of these, because for me, I find it rather entertaining to see what is inside each class. It's kind of a light bulb, I didn't know that type of moment. So we have asset class 00.11, and it includes office furniture, fixtures, and equipment. It includes furniture and fixtures that are not a structural component of a building. It includes such assets as desks, files, safes, and communication equipment. It does not include communication equipment that is included in other classes, however. And the class life of office furniture, fixtures, and equipment is 10 years. And under a general depreciation system, though, you will be allowed to use a 7-year recovery period. Under ADS, you're stuck with the 10 years. For information systems, these include computers and their peripheral equipment used in administering normal business transactions and the maintenance of business records. Their retrieval and analysis. Information systems are defined as computers. And a computer is a programmable, electronically activated device capable of blah, 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 on it goes. It also includes peripheral equipment, and this consists of the auxiliary machines which are designed to be placed under the control of the central processing unit. Non-limiting examples include things like card readers, card punchers, magnetic tape feeds, high-speed printers, optical character readers, tape cassettes, mass storage units, paper, tape equipment, key punches, data entry devices, teleprinters, terminals, and on it goes. Peripheral equipment may be used online or offline. It does not include equipment that is an integral part of other capital equipment that is included in other classes of economic activity. And then it says, i.e. computers used primarily for process of production or control switching channel and automating distributive trades and services such as point-of-sale computer systems, also does not include equipment of a kind used primarily for amusement. And then we move on to the next category, which is data handling equipment. It includes only typewriters, calculators, adding machines, copiers, etc. So each of these classes has a description of what's included in it. If you have a question about what you can depreciate, this is where you go. If you're looking at an information system, the class life is 6 years. But under both GDS and ADS, the depreciable life of that asset is the same at 5 years. We've also got a class for airplanes. We've got a class for automobiles and taxis. And the class life of an auto or a taxi is considered to be 3 years, but the depreciable life, oddly enough, in this case is higher, set at 5 years. Buses have an asset class life of 9 years. Under the general depreciation system, you depreciate a light truck at 5 years, and under ADS, it's 9 years. And moving on, we can see other classes of light general purpose trucks and heavy general purpose trucks. And it's kind of important to pay some attention to some details here. A light general purpose truck includes trucks for over-the-road use whose actual weight is less than 13,000 pounds, as opposed to a heavy general purpose truck, which includes general heavy trucks, concrete ready mix trucks, and ore trucks for use over the road with an actual unloaded weight of 13,000 pounds or more. And then we have trucks and locomotives and trailers and land improvements. Land improvements is an important one. Let's look at it. Land improvements include improvements directly to or added to land, whether such improvements are Section 1245 property or Section 1250 property, provided such improvements are depreciable. Examples of such assets include things like sidewalks, roads, canals, waterways, drainage facilities, sewers, not including municipal sewers, wharves and docks, bridges, fences, landscaping, shrubbery, or radio and television transmitting towers. Does not include land improvements that are explicitly included in other classes and buildings and structural components as defined in Section 1.481E. That was interesting, wasn't it? Let's move on. Now we're into the world of farmers. You've got a whole bunch of information on how you depreciate assets used in farming, including cattle, breeding, or dairy. They have an asset class life of 7 years, a depreciable life under GDS of 5 years, and under ADS of 7 years. You'll notice that there's 3 different classes of horses. Any breeding workhorse that is 12 years old or less. We have any breeding workhorse that is 12 years old at the time it is placed in service. Any race horse that is more than 2 years, and any horse that is more than 12 years old at the time it is placed in service that is neither a race horse nor a horse described in another category. So it's kind of interesting. 4 different classes of horses. And then we move on to hogs and sheep and goats. Well, although a horse can be divided into 4 different classes depending on the exact description of that horse, sheep and goats are general. We'll throw sheep in the same category as goats, and so on. So farm buildings, an important one here would be most farm buildings except certain other structures used in farming, but the barns themselves are 25-year life assets. class life assets, and they're depreciable under MACRS over 20 years or under ADS under 25 years. And with that, I'm going to just kind of flash through here. Most of the other items on here are very specialized: manufacturer of tobacco, manufacturer of textiles, manufacturer of rubber. Not typically the thing that the average business is going to be dealing with. We've got automobile manufacturers, locomotive manufacturers, and so forth. So most of what we would ever need to consider or look up for our clients is really on those first 2 pages of the table. So I think we've really done a good job of showing you what's in 946 and some of the descriptions in there. But let's take a look now at the summary. I've gone into that table and pulled out a summary of the most common types of assets you would typically run across that your clients need you to put on a depreciation schedule and figure depreciation for. And so we're going to take those in turn. Firstly, we have 3-year property, and it includes any qualified rent-to-own property. Any racehorse, without regard to the age of the horse, placed in service after December 31, 2008 and before January 1, 2014. Any horse other than a racehorse that is more than 12 years old. 5-year property includes automobiles, light general purpose trucks, typewriters, calculators, copiers, and duplicating equipment, any computer or peripheral equipment, appliances, carpets, furniture, etc. that are used in a rental real estate activity, and restaurant use food storage, cleaning, preparation, and delivery systems, including furniture and fixtures used to process food items for delivery to the customers. These particular assets fall under Asset Class 57.0, Distributed Trades and Services. 7-year property includes office furniture and equipment, and any property that does not have a class life and is not otherwise classified. So if you've got a particular asset that you can't seem to find anywhere that it's listed in the classification tables, it's just not identified anywhere, then it would be described as 7-year property. Happens to be the case that as hard as I've looked, I've never once seen cell phones listed in those tables, and since I don't see them listed in the tables, I've always treated cell phones as being 7-year property. Never seen a cell phone last 7 years, but since it's not classified into any other class, that's what I've been left with. 10-year property includes vessels, barges, tugs, and similar water transportation equipment, any tree or vine bearing fruits or nuts, any qualified smart electric meter and qualified smart electric grid system placed in service after October 3, 2008, and any single-purpose agricultural or horticultural structure. 15-year property includes any qualified leasehold improvement property placed in service before January 1, 2014, any qualified restaurant property placed in service before January 1, 2014, and other types of land improvements such as fences, landscaping, and shrubbery. 20-year property includes farm buildings that are not single-purpose agricultural or horticultural structures. And 25-year property is water utility property, which can include property that is an integral part of the gathering, treatment, or commercial distribution of water that, without regard to its classification, would be 20-year property. It also includes municipal sewers. This classification does not apply to property placed in service under a binding contract in effect at all times since June 9, 1996. 27.5-year property applies to residential rental property. And residential rental property is a building for which 80% or more of the total rent comes from dwelling units. And the reason they have that percentage there is it's possible, and I certainly frequently see it here in Portland, that you might have retail space underneath residential space, and you've got one person or business that owns the entire building. And is that building going to be depreciable as residential rental, or is it going to be depreciated as commercial? And the question is, the revenue coming into that building, is 80% or more of it coming from residential renters? And if it is, then it would be 27.5-year property. If it is not, then it turns into 39-year property, which applies to all non-residential real property, essentially commercial buildings. So non-residential real property is any real property that is neither residential rental property nor property with a class life of less than 27.5 years. Got a little note in here on small wares for restaurants and taverns. The IRS ruled several years ago that small items such as glassware, cutlery, and kitchen utensils and small appliances costing $500 or less may be expensed in the year placed in service, even though their useful life is expected to be slightly greater than 1 year. So if you're in a restaurant business and you're out there constantly replacing pots and pans and small appliances like mixers, Dishes are constantly breaking. The IRS says you don't need to worry about tracking whether or not any of those items belong on a depreciation schedule. If you paid $500 or less for them, you can write them off as a cost of doing business, and probably the place to put that expense would be under cost of goods sold. That would be my instinct. The next topic of the day is 15-year MACRS life for qualified leasehold improvements. You heard me mention on the preceding page that qualified leasehold improvements qualify as 15-year property. So what exactly is a qualified leasehold improvement? Well, qualified leasehold improvement property and qualified restaurant property placed in service after October 22, 2004 and before 2014 are treated as 15-year property, and they stand out as being unique. It's supposed to have been a temporary law, but every year since 2004 it's just been extended and extended and extended, and now the new deadline is the end of this year. Any property placed in service after 2013 is technically going to be 39-year property again, but for now, qualified leasehold improvements do qualify for a 15-year life, and essentially a qualified leasehold improvement is improvements being made by a tenant to property that they're leasing for use in their business. Single-purpose agricultural and horticultural structure. You may have been wondering what those are. A single-purpose agricultural structure is used for livestock, and horticultural structures are used for plants, growing things that grow. And they qualify, both of these, single-purpose agricultural and horticultural structures qualify for special depreciation treatment, including a 10-year life and eligibility for expensing under Section 179. The information I'm about to give you comes from IRS Publication 225, that is the IRS Farmer's Handbook, and it comes from page 39. Page 39 of Publication 225 describes an agricultural structure in the following way. It is a single-purpose agricultural livestock structure. That type of structure is any building or enclosure specifically designed, constructed, and used for both of the following reasons: to house, raise, and feed a particular type of livestock and its produce, to house the equipment, including any replacements needed to house, raise, or feed the livestock. And for this purpose, livestock includes poultry. But yesterday when I actually went and read the code goes out of its way to say it does not include horses. So I found that interesting. It makes sense that if you were breeding horses that they would still be considered livestock, but the publication said horses are not livestock. Single-purpose structures are qualifying property if used, for example, to breed chickens or hogs, produce milk from dairy cattle, to produce feeder cattle or pigs, broiler chickens, or eggs. The facility must include as an integral part of the structure or enclosure equipment necessary to house, raise, and feed the livestock. A horticultural structure is a single-purpose horticultural structure is either of the following: a greenhouse specifically designed, constructed, and used for the commercial production of plants, or a structure specifically designed, constructed, and used for the commercial production of mushrooms. They do belong to the plant family as well, so it's a greenhouse. Use of structure. A structure must be used only for the purpose that qualified it. For example, a hog barn will not be qualifying property if you use it to house poultry. Similarly, using part of your greenhouse to sell plants will make the greenhouse non-qualifying property. If a structure includes workspace, the workspace can be used only for the following activities: stocking, caring for, or collecting livestock or plants or their produce, maintaining the enclosure or the structure, maintaining or replacing equipment or stock enclosed or housed in the structure. Computer software and other tangible property. And we're going to just talk briefly about what special rules you should have in mind for computer software. You may have noticed on this list of assets that I have right here that I never mentioned computer software. And it's because computer software is not depreciated under MACRS. It's in a category that stands out all by itself, and for that reason I decided to make it stand out all by itself right here. Computer software cannot be depreciated using MACRS because it is considered to be an intangible asset. While IRS does allow most off-the-shelf software to be depreciated, straight line rather than MACRS depreciation is used. Certain Section 197 intangible computer software that is acquired with a business. This is a heading for a topic that is going to explain the difference between off-the-shelf computer software and other types of software that cannot be depreciated. Computer software is a Section 197 intangible and cannot be depreciated if you acquired it in connection with the acquisition of assets constituting a business or a substantial part of a business. However, computer software is not a Section 197 intangible and can be depreciated even if acquired in connection with the acquisition of a business, if it meets the following tests. Number one, it is readily available for purchase by the general public. It is subject to a non-exclusive license, and it has not been substantially modified. And then the IRS goes on to describe some special rules for depreciating certain types of intangible property. Now, earlier I just finished telling you that you can't depreciate intangible property, but there are just certain oddball types of property that on the surface are intangible, but the IRS allows them to be depreciated anyway. And in the case where it does allow depreciation of intangible property, you have to use the straight line method. The method, the straight line method, lets you deduct the same amount of depreciation each year over the useful life of the property. If in the first year of the use of the property you use it less than a full year, then you must prorate your depreciation deduction for the number of months in use. And this particular illustration I'm reading to you, or example that I'm reading to you, is straight out of publication 946. It's not modified in any way. It says, in April, Frank bought a patent for $5,100 that is not a Section 197 intangible. He depreciates the patent under the straight line method using a 17-year useful life and no salvage value. He divides the $5,100 basis by 17 years to get his $300 yearly depreciation deduction. He only used the patent for 9 months, that is April through December, during the first year. So he multiplies 300 by 9/12 to get his deduction of $225 for the first year. Next year, Frank can deduct $300 for the full year. So there's a couple of things going on in this equation that I wanted to point out to you. The useful life of this asset, they're saying, is 17 years. And so to get the annual depreciation, you'd quite logically divide $5,100 by 17 years. And when you do that, you get the $300. However, in the first year, because it's placed in service in April, he's only getting the 9 months. So then you're going to take 300, divide that by 12, multiply it by 9, and you get the allowed deduction for the year, which is $225. And where would you enter that deduction of $225? You would enter it on line 16. Other depreciation, including acres depreciation, is entered on Part 2 of Form 4562, line 16. Now, qualified computer software is depreciated straight line over 36 months, and you would figure the amount of depreciation you can claim following the instructions I just showed you above. But instead of using a 17-year recovery period, you would use a 3-year recovery period. And off-the-shelf computer software is eligible for the Section 179 deduction. That is something you are allowed to claim. So we're at an excellent stopping point for a break, and I do see some questions have come up. Since the useful life in ADS are longer, why would one elect ADS? Well, you would elect ADS if you don't want to depreciate too quickly. Maybe you've got not a lot of revenue coming in early on, and you don't want to use up really good deductions that you think you would like to save for later on. So it can be worthwhile to spread depreciation out over a longer period of time. With the last big economic recession we had, the government was passing all kinds of rules to allow businesses to speed up depreciation and claim some big write-offs and reduce their tax bills. But those ability to claim those big write-offs were at the same time a lot of those businesses were making less money than they'd ever made. And so, yeah, maybe they needed to save money on their taxes just to stay afloat, and those big deductions are helpful to them. But you might have had a business that says, well, you know, things are down a little bit, but we're all comfortable now. I don't want to be taking a depreciation deduction to keep me in the 25% tax bracket when I'm already in the 25% tax bracket, because when you come out of this recession, I'm going to move into the 35% bracket, and I want to save those deductions for later on when they're going to do me more good. So there can be lots of reasons to select a longer life, although most people don't typically think of that. And then it says, does the lease term affect leasehold improvement life? The answer is no. So that's kind of a big deal. Let's suppose you sign a 5-year lease on a commercial space, and you go in there and you spend $60,000 fixing it up. The depreciable life normally of those expenditures is 39 years, even if you have a 5-year lease. But right now we do have leasehold improvements falling under 15 years, which does allow you to claim a Section 179 deduction, to claim bonus depreciation, to claim accelerated depreciation, and write those off sooner. But you can see that even at those tax benefits, 15 years could definitely be a lot longer than the lease signing period. But the rule is, if you sign a lease and you do leasehold improvements and you fall under that 39-year test, that if the lease ends and you walk away from it, essentially you have at that point a disposition of your property, and you would write off the difference or claim a deduction for your loss on the disposition of that property when you file Form 4797 to report the disposition. Next question. The accounting software and tax software I purchase each year can be done under a straight line depreciation for 3 years. I'm rather aggressive about computer software when it comes to tax software because I consider tax software to have a useful life of, well, less than a year. It's good for the tax season, right? So I've never been audited. I've never read a court case on it. Maybe IRS has something on it somewhere that I haven't learned about. But at any rate, I've just looked to the useful life test. And when I purchase my tax software, it has a useful life essentially from that first, maybe 15th of January through the 15th of April. And then, until we get to the extension deadline in October, we're using it quite a bit. But by the time we're past that, it's pretty much retired. It's just being used the oddball time to do a back year return. And so that's the argument I've always made personally. If anyone knows otherwise, you can let me know. Plus, we have the Section 179 deduction as small business owners. So if you're in doubt, just stick it there and then you're good to go. I understand the back tax software concept, or the back year concept. So you could argue 3 years, and if you want to be super careful, then you would just put it under 3-year depreciation and claim a Section 179 deduction on it. If you can successfully argue to an auditor that that software has a useful life of less than a year, and it probably wouldn't be hard to convince them of that, unless, of course, there's some court case out there they're falling back on where a tax accountant or a CPA went to court and lost over their tax software deduction. I suppose it's possible. I just never heard about it. There's a question here, is the depreciation charge recouped when an asset is sold? The answer is, when you are looking at the sale of an asset and whether you have a gain or a loss on the asset, that is determined based on the adjusted basis of the asset being subtracted from the sales price. If you sell an asset for nothing and you still have basis left in it, then at the time you sell it, you have a loss. And if your adjusted basis is less than the sales price, then you have a gain. And that is going to be the very next topic in our 1040 CPE series. Next Wednesday, I will be teaching about sale of assets. We'll really get into how you prepare a return selling assets, including all different types of assets that have been subjected to various types of depreciation and or amortization. So today I'm not going to be really talking about that. That's not the focus of today's class at all. SWORD. S-W-O-R-D. SWORD. Okay, everyone. So we're going to move on next with a discussion of depreciation conventions. And I've always made a little bit of fun of depreciation conventions simply because when I think of a convention, I think of a convention as a gathering of people. You have the Democratic Convention, you have the Republican National Convention, you have conventions where you go and learn about tax law. But in depreciation, we have a different kind of convention. But it still makes me think of those other kinds of conventions. Now, in applying either ACRS or MACRS depreciation methods, you must first determine what depreciation convention applies. The depreciation convention determines what date your asset will be treated as having been placed in service. The 3 depreciation conventions include mid-month, half-year, and mid-quarter. So we're going to talk about each of these in turn. Beginning with the mid-month convention. This convention applies to residential and non-residential real estate. And under the mid-month convention, any asset placed into or taken out of service during any part of the month is treated as placed in service or disposed of in the middle of the month. So you see I've got a calendar here. And if you purchase an asset that is real estate, and you're going to be claiming depreciation deductions for that real estate, then the date you bought it, it doesn't really matter what day of the month you bought it, when you place it in service, depreciation will be calculated, assuming that it was placed in service on the middle day of the month. So here is an illustration of how the mid-month convention works. You purchased a residential rental property on June 1, 2012. Under the mid-month convention, the property shall be treated as having been placed in service on June 15 and will be allowed 6.5 months of depreciation for 2012. So here we have the residential rental property. We have the cost of the property at $150,000. And remember the all-important rule, which is that land is never depreciable And therefore, whenever you purchase real estate, the first question you should be asking yourself is, okay, what's the land value? Because I need to subtract that out. So in this situation, land is $50,000, the property cost is $150,000, so the basis for depreciation will be the difference between those two numbers, $100,000. We then look to the date placed in service. If it's placed in service on June 1st, 2012, and it's 27.5-year property, then we're going to assume that it was placed in service in the middle of June. If it's placed in service in the middle of June, it means that we get 1/2 month of depreciation for June, and then we get depreciation for the remaining 6 months of the year in full. So in other words, we get 6.5 months of depreciation. So how would we work this formula? Well, we take $100,000 of depreciable cost in the rental property, divide that by 27.5 years, divide that by 12 months, and then multiply that result by 6.5 months. And when we do that, we get $1,970. Now, to just reinforce how that formula works, I've got a class assignment here for you, and I promised that you needed a calculator because we were going to stop and work on some classwork assignments together. This is the first one. And what I'd like you to do is, using the straight line depreciation system that I just showed you, apply the mid-month convention to figure the amount of depreciation for each of the following types of assets that was placed in service during the year. And here we have a commercial building, we have an HVAC system, and we have a residential rental property. So just take a couple of minutes and with your handy-dandy calculator, figure out what you think the depreciation is for each of these assets. Of course, you need to start with the class life, fill that in as well, and then enter the depreciation deduction that you figure. So with regards to the first asset, the commercial building, $8,974, and the formula for getting that is you start by taking the cost of the asset, $500,000, and of course you have to subtract out the land value. So the depreciable basis for the building is $400,000. It was placed in service in the middle of February. So it's going to be 11.5. 400,000 divided by 39 years. Therefore, the answer is $8,974. So back to that first answer. So now you can see how difficult it is to sometimes figure this stuff, because you have to be looking at the number of months that are left in the year and then add to that the months that you're in. February is the 11th month, but you only get half of it. So you have 10 months plus half of the 11 months, that is 10.5. Let's move on to the next one. But actually, in the next one, you had to figure something out really quickly. And one of the things that happens with real estate when it comes to depreciation is there's certain components of a building that the IRS says take on the same life as the building. And that includes HVAC systems, which is heating and air conditioning. So if you make an addition to a building or you make an improvement to a building that includes installing a new furnace, a new air conditioning system, and it becomes an integral part of that building, then it takes on the same life as the building. And therefore, the HVAC system is 39-year property. And so to calculate the depreciation on that 39-year property, we're going to take that same formula of 39 over 12 times 10.5, but we're going to start with the depreciable cost of the HVAC system, which in this case is $30,000. And we're going to divide that by 39 years, and then divide that again by 12, multiply that by 10.5, and when we do that, we get $353. Let's look at the final asset in line. The final asset in line is the residential rental property. And the residential rental property is a 27.5-year asset, and it has a depreciable cost of $200,000. So in this case, we're going to go $200,000 divided by 27.5 years, divided by 12 months in the year, multiplied by the number of months of depreciation that we get. Well, since it's placed in service the second last month of the year, we're going to get half of November and all of December, which is 1.5 months. And then we're going to take and do the formula, and when we're done, we end up with $909. So let's move on now with the next convention. So I think I've explained to you how straight line works and the mid-month convention. Now we're going to go on to the half-year convention, and the half-year convention is really easy. It's the easiest of all the conventions. This convention, that is the half-year convention, applies to property used other than for rent. Under the half-year convention, any asset placed into or taken out of service during any part of the year is treated as placed in service or disposed of in the middle of the year. And here's an illustration. You purchased a photocopier for $5,000 in November 11, 2012. Assume the total value of all assets placed in service during the last quarter of the year was less than 40% of the total of all assets placed in service for the entire year. That's an important assumption, because if that is the case, that more than 40% were placed in the last half of the year, then you couldn't use the half-year convention. So we're making sure that you know you can use it. Now, under the half-year convention, the copier will be treated as placed in service on July 1st, 2012, and shall be allowed 6 months of depreciation. If you are depreciating the computer straight line over 5 years, you figure your first year depreciation as follows. You're going to take $5,000 cost of the computer and divide that by the depreciable life of the computer, 5 years. And then that computer is treated as placed in service in the middle of the year. So you get half a year of depreciation for the first year. And therefore you're left with 500. So 5,000 divided by 5 would be 1,000. Multiply that by 50% to apply the half-year convention, and you're left with a deduction of $500. So that brings us on to classwork exercise number 2. And do the best you can. It should be faster and quicker than the last one. All right, let's broadcast the results from the first exercise, and you can just see where your answer falls. So let me pull down the formula and kind of the note share here and show you the formula for this one. And in this one, we're talking about the computer. And the computer is costing $3,000. And what's the useful life of a computer? It's going to be 5 years. Now, under the mid-year convention or the half-year convention, we don't need to worry about figuring out the number of months and doing those calculations. Let me see, if I take February, is that 11.5 months or is that only 10.5 months? You don't have to worry about anything that complicated. All you have to worry about is that because it's a computer and it falls into the half-year convention, and under the half-year convention you figure straight line and divide the result by 2. So if we take 3,000 and divide that by 5, we're going to get a number, and then we divide that number by 2. And when we're done, we get $300. And 300 is the correct answer for question number 2 on the computer. The next asset in line is the fence. And what is the depreciable life of a fence? 15 years. So on the fence, we're going to say $30,000 of cost divided by 15 years divided by 2. And when I do that, I get $1,000. And then the final question is to do with the desk. And the desk, of course, costs $500. And what is the depreciable life of a desk? 7 years. So the formula is going to be $500 divided by 7 years divided by 2. And when we do that, the correct answer is $36. $35. It depends on where you round it out. How you round your numbers is where you put it. And when I created the poll, I rounded to 35, and when I did it in my handbook, I came up with 36. So I'll be consistent and go with 35. You're supposed to round up to the nearest dollar, so depending on what your calculator shows you, that's where you're going to go. I'll pull mine out and do a test here. 500 divided by 7 divided by 2. 35.7. So the correct answer is 36. If you had 35, you're close enough. I don't think IRS is going to arrest us over the $1 off. All right, so let's close out this poll and move on to the next convention, which is, I consider to be the most confusing of the conventions. It's the mid-quarter convention. It's neither mid-month nor half-year. It's in the middle. It's mid-quarter. And trying to figure out the middle of a quarter, that's a real brain teaser, especially for me. So the mid-quarter convention applies when more than 40% of assets that would normally be eligible for the half-year convention were placed in service in the last 3 months of the year. Well, is an HVAC system eligible for the half-year convention, folks? The answer is an HVAC system is not eligible for the half-year convention, nor is any other form of real estate. So when you're looking at the value of assets placed in service during the year, you will never factor in the cost of any item that is deemed to be real property. You're only going to look at personal property that is eligible for the half-year convention. So if you narrow it down and you're only looking at personal property eligible for the half-year convention, is the total cost of all assets eligible for the half-year convention that were placed in service during the year was more than 40% of that cost attributable to the final quarter of the year. And the final quarter for calendar year filers is October, November, December. If you're fiscal, it would be different, but we're going to work off the calendar system to keep it understandable. So let's take a look a little bit more about how we arrive at the factors or the numbers we're going to use in figuring the mid-quarter convention and how we apply it to assets that must be depreciated with that application. You must apply the mid-quarter convention instead of the half-year convention if more than 40% of the cost of assets placed in service during the year was placed in service in the last 3 months of the year. The 4 mid-month rates are determined as follows. 10.5 months if placed in service in the first quarter. That's January 1 through March 31. Well, if you look at that 3-month period, January through the end of March, the middle of that 3 months, so you can see my hand, the middle of that 3 months is February 15. And I think we figured out in the first illustration of the day that February 15 means we have 10.5 months of depreciation. We get half of February and all of the other months that follow it. That's 10.5 months. If you are required to use the mid-quarter convention and you place an asset in service in the first quarter, then you will be allowed 10.5 months of depreciation for that asset in its first year in service. If you purchase an asset and place it in service in the second quarter of the year, then you are allowed 7.5 months of depreciation. And where do we get that? Well, the second quarter runs April 1st through the end of June. So April 1 through June 30th, and what's halfway between those two dates? May 15. And May 15 is where you get 7.5 months. You get half of the month of May, you get June, and then you get the rest of the 6 months of the year. So that's where 7.5 comes. 7 including June plus half of May, 7.5 months. And then we move on to the third quarter of the year. Well, the third quarter of the year runs July 1 through September 30, and halfway between those two dates is August 15, and therefore you get all of December, November, October, September, and half of August. So 4.5 months if you place it in service in the third quarter. And if it's placed in service in the final quarter of the year, you're going to get 1.5 months. And that's going to be figured with October 1 through December 31 and November 15 being the middle of that third quarter. And of course, that means you get all of December plus half of November. That's 1.5 months. Let's move on to an illustration of the mid-quarter convention. In this illustration, more than 40% of the assets were placed in service in the last quarter, and you purchased the following assets during 2012. A photocopier, which is 5-year property, costing $10,000, and you purchased that on February 11th. There was a printer, also 5-year property, costing $1,000, and purchased on May 11. We then have a computer that is 5-year property. It costs $3,500. You purchased it on 11/1/12. And then finally, furniture, 7-year property, $2,500, purchased on 12/1/12. When you add up the cost of all of those assets, you'll see that these last two assets are $5,000. The first two assets are $6,000. So we're more than 40% of the assets placed in service in the final quarter, and that means that the mid-quarter convention must apply. And when we go down to that, we're going to look at the photocopier first. It was placed in service in the first quarter of the year, so it will be allowed 10.5 months of depreciation. The printer was placed in service in the second quarter, so it will be allowed 7.5 months of depreciation. The computer was placed in service in the fourth quarter. It will be allowed 1.5 months. And the furniture was placed in service in the fourth quarter. It also will be allowed 1.5 months. So let's take this formula and run it out. We have the photocopier, $5,000 divided by 5 years, multiplied by 10.5 divided by 12. Or you could go divided by 12 times 10.5. You'd get the same result either way, $875. We have the printer, $1,000 divided by 5 years, multiplied by 7.5 divided by 12, and we get $125. The computer is $3,500 divided by 5 years, multiplied by 1.5 months over 12, and we have $87. And then finally, the last deduction is for the furniture, and we'll end up with $45 following that formula. So I've got you onto the next exercise of the day, which is for you to use the formulas that you see shown here to figure the depreciation for the assets shown in this table. We have a computer system, display cases, and leasehold improvements. And your job is to remember the class life of each of these assets, use the mid-quarter convention calculation to figure the depreciation you're going to claim for each of those assets. All right, so we've gone through the half-year, the mid-quarter, and the mid-month convention, and all of the calculations for these particular class exercises are included in the manual at the very back. It is on page, not the very last page, but page 70 of the manual. I'm just going to take you there real quick. On page 70 of the manual, if you want to have a way of remembering how I did my formulas, you'll see that the answer key is shown here. And I'll uncover it. So you can see classwork exercise number 1. We've gone through and shown you the class life of each asset, the depreciation that we calculated. On classwork exercise number 2, I do actually have the correctly rounded number at $36 in the answer key. And then for classwork exercise number 3, I've actually put the formula in for you. 6,000 divided by 5 divided by 12 multiplied by 10.5 is 1,050. So those are all the correct answers, and you got the final one. Everyone who did the effort and put up the answers had the correct answers, so that's great. Because from this point, it's just going to get a little bit more complicated. So we're moving back to page 15 of the manual now, and we're going to be moving on to depreciation methods. So we've talked about depreciation systems, we've talked about depreciation conventions, and now we're going to talk about depreciation methods. Both ACRS and MACRS allow a business to claim depreciation on certain property under either of the two methods, the straight line method or the accelerated method. Under the straight line method, the cost of property is recovered equally over time. This means the deduction claimed is the same amount every year. And so in the 3 class exercises we just went through, we used the straight line method. I used the straight line method because I hadn't taught you accelerated yet, and I wanted to keep those exercises to the point and talking only about the convention. But now we're going to have to take similar types of concepts and start applying accelerated depreciation. And under accelerated depreciation, we get to claim more depreciation than we do under straight line for a little while. So under the accelerated method, the cost of property is recovered unevenly over time. More depreciation is claimed in the early years, and less depreciation is claimed in later years. Applying these different methods, or applying the MACRS method of depreciation, is what we're going to be focusing on now. Depending on the class type of asset you are recovering, MACRS applies the following depreciation methods: straight line, 200% declining balance, or 150% declining balance. For MACRS straight line depreciation is optional for some classes of property and is required for other classes of property. The following property must be depreciated straight line. It includes residential real property, which is 27.5 years, straight line, and commercial real property, including office and home, is 39-year property. Now, I pointed out including office and home here because I often see tax practitioners assume that because the office is in the home and the home is residential, that 27.5 years would apply. But residential is referring to the use of the property, and if you are using it for your business, it's not being used for residential rental income, it's being used for a business. And therefore, office and home is 39 years, as is any other commercial use real property. Now, even though you can use accelerated method for other types of property, you can still choose to use straight line. So there is an optional straight line that can be used for 3, 5, 7, 10, and 15-year property. All of these assets can be depreciated straight line, and to depreciate any of these assets straight line, you must make an irrevocable election to treat all assets of the same class under the straight line method that were placed in service during that same year. And here's an illustration of what I mean by that. Remember when we looked at the MACRS tables at the end, or the depreciation class lives tables at the very end of this manual, and they come out of publication 946, and I was showing you class lives of assets? If you make an election to treat one asset in a particular class under the straight line method, then any other asset you place in service in that same year that belongs to that same class must also be depreciated straight line. So here's an illustration. You purchase a new computer during 2012 for $2,000. You can depreciate the computer using the straight line method over 5 years, or you can use the declining balance method over 5 years. Under the straight line method, you depreciate the computer in equal amounts over a 5-year period. Straight line depreciation is a good choice if you would like to see the cost of an asset spread equally over time. We have the purchase price that is $2,000 for this illustration. And under the straight line method, depreciation would be $2,000 divided by 5 years, and that would give us 20% average depreciation for the year. But then we have to apply the half-year convention for that first year, and so in the first year we only get half a year of depreciation, or $200. So let's look at this table here, where I've essentially summarized the depreciable life of this computer. The computer is 5-year property, but in the first year you get half a year of depreciation, and in the last year you get half a year of depreciation. So technically speaking, you're claiming deductions for this 5-year property over a period of 6 years. And in the first year, you're going to get $200 of depreciation. You're going to go 2,000 times 20% equals 400. Multiply that by the half-year convention, $200. The second year, you start with that same $2,000 acquisition price. Multiply that by 20%, $400. The third year is $400. The fourth year is $400. And in the fifth year, you are $400. And then finally, in that sixth year, you claim the final $200. So if you're talking about the concept of accumulated depreciation, that means how much depreciation have I taken to this point in time. The first year accumulated depreciation would be $200. You're going to add $400 for the second year, add $400 for the third year, add $400 for the fourth year, $400 for year 5, and finally at the end of the sixth year, you've recovered all $2,000 of depreciation. So if you were to look at how the depreciation is being claimed over time, you'd have year 6 and year 1 being an equal amount of depreciation, 10% of the cost of the asset, and every other year in between being exactly the same amount of depreciation, which is 20% of the cost of the asset. Electing straight line in place of accelerated depreciation. Again, if you elect to use the straight line method for an asset that qualifies for accelerated depreciation, you must also use the straight line depreciation method for all other assets belonging to the same class of property that you placed in service during the year. And here's an example where we're applying that same straight line method to all property in the class. You decide to depreciate your new computer purchased in 2012 over a 5-year period straight line. In making this election, you must also depreciate all of the other assets placed in service during the same year that belong to the same class as that computer. You cannot use the straight line for your new computer and then use accelerated depreciation for your new printer during that same year because they belong to the same class. You could, however, choose straight line for your computer and the printer, but then choose accelerated depreciation for office furniture because office furniture belongs to a different class than office equipment. So let's see how the 200% MACRS and the 150% declining balance work. And sometimes you might just hear me refer to double declining balance. If you hear me say double declining balance, or just out there in the layman term you hear someone refer to double declining balance, it simply means 200%. 200% is double that of 100%. So if you do hear me saying double declining balance, that's what I mean. So for MACRS, you have a choice with accelerated depreciation. You can claim 200% depreciation, or you can take 150% declining balance. The two different declining balance methods are applied as follows. If you're using 200% declining balance, you can use that for 3-year property that is non-farm, 5-year property non-farm, 7-year property non-farm, and 10-year property except fruit-bearing trees and vines. The 150% declining balance applies to 15-year property, 20-year property, 3, 5, 7, and 10-year non-farm property, and all other farm property except real property. So in general, if you're working on a farmer's tax return, the farmer does not get to use 200% declining balance. The farmer uses 150% declining balance for the same type of asset that if it was placed in service in another business would be depreciated using 200% declining balance. So let's talk now about 200% declining balance. 200% declining balance is a method of accelerated depreciation. Under this method, you are allowed to recover more of your cost early on. Specifically, you are allowed to claim 200% of what would normally have been allowed under the straight line method for that first year. Each year after the first year, you are allowed to claim the remaining unclaimed basis at the same rate using the MACRS depreciation tables. The tables are designed to work according to a set formula over the useful life of the asset. However, depending on the life of the asset, the formula changes to straight line after the fourth year. And here's an illustration, 200% declining balance method. You purchase a new computer during 2012 for $2,000. You can depreciate the computer using the straight line method over 5 years, or you can use the 200% declining balance method over 5 years. The 200% declining balance method allows you twice the first year depreciation that is allowed under the straight line method. The intention of 200% declining balance is to allow a greater depreciation deduction early on, but less depreciation later on. So just as in my earlier discussion about why someone would choose a longer life for an asset, for that same reason a person might choose, or a business might choose, to not use double declining balance. They might instead choose to use straight line so that they can have more depreciation deductions later on. Now bear in mind that your tax software in all likelihood is probably defaulting to accelerated depreciation. And so if you think your client might benefit from straight line, that's a discussion you have with them, and you're probably going to have to override or make selections in your computer to choose straight line. So 200% declining balance is beneficial if you need more depreciation earlier on in the earlier years of the asset's useful life. Now, what would be a reason to claim more depreciation early on? Well, the business just forked out money for that asset, right? And it's going to have to pay tax based on more income than they really feel like they had. If you're looking at cash flow of a business, and a business has $100,000 of profit, but during the year it spent $20,000 on computers, and so even though it has a cash flow profit of really $80,000, for tax purposes it has a profit much higher than that, unless the business is somehow able to claim a deduction for all of the cost of the computers. And there are ways that they can do that through Section 179. We're going to talk about those. But maybe it doesn't want to deduct all of the cost of those computers up front. Maybe it wants to claim accelerated depreciation, or maybe it wants to minimize its deduction by going straight line. So let's take a look again at the computer. Same computer that we applied the straight line method to. Now we're going to take that computer and see what happens to its cost when we recover it under 200% declining balance. We take the purchase price of $2,000, and if we apply 200% declining balance, then the first year depreciation would not be 20%, it would be 40%. And that would give us an $800 deduction, except for the fact that we now have to apply the half-year convention. So in the first year, we'll take that $800, apply the half-year convention, and we're left with a $400 deduction. So $400 is twice what you would get under straight line, which is, of course, $200. Now, for each of the first 4 years, you claim 40% depreciation on the remaining balance of the cost of that computer. The formula will change to straight line for the final 2 years. So let's look at what's happening with the formula here. In the first year, we're claiming $400 of depreciation. And the percentage that we're using, if you were to go look up the percentage in IRS tables, is 20%. You're going to get $2,000 multiplied by 20%, and you get a $400 deduction. Now, in the second year, you have this accumulated depreciation of $400, and you have to subtract that from the purchase price. So you're going to take $2,000, subtract $400, and multiply that difference by 40%. When you do that, you get $640. And $640 is the amount of depreciation you're allowed in the second year. Now, if you look at the MACRS tables simply say take $2,000 and multiply that by 32%. If you do that, you still get $640. But the formula that gets you to the $640 or to the 32% is taking the first year of depreciation, subtracting it from the cost, and multiplying the difference by 40%. In the third year, we're going to have to reduce basis by the preceding 2 years. 400 plus 640 equals 1,040, and we're going to subtract 1,040 from 2,000, multiply the difference by 40%, and we get 384. In the fourth year, we take 2,000, minus out all of the accumulated depreciation to that point, which is 1,424, multiply it by 40%, and we get 230. Now, at this point, the tables switch to straight line, and the reasoning is that as soon as future years' depreciation will be less than what you would be able to get just by going straight line, you just go straight line. That's kind of the description I've read. You'll see it in the IRS tables. And I do have the IRS tables coming up in here shortly. They're also in publication 946. So you'll be seeing where these percentages come from. These are published by the IRS in 946, and you can use these percentages instead of the formula because they get you to the same place. At any rate, the accumulated depreciation under this system, we end up recovering the full cost of the computer in the final year. We've got $1,999. Just because of rounding, it doesn't come to $2,000, but ultimately you would be allowed to have recovered that full $2,000. So the accelerated method allows more depreciation to be claimed in the early years, with year one being more than all of the other years except the second year. And the reason for that is, of course, that in the first year we are allowed 40%, but we have to apply the half-year convention. And then in year two, we don't have to apply the half-year convention, but we're claiming 40% of the remaining balance. And so we end up with claiming the largest amount of depreciation actually in year two. And then every year after that, the amount of depreciation deduction goes down. So this table here, we've got green showing how straight line accumulates depreciation, and we have in pink how double declining balance accumulates depreciation. And you can see early on that we're getting a larger deduction under the 200% declining balance method. But as soon as we hit year three, now straight line is giving us larger deductions. So it's only for the first 2 years that we see a greater deduction, and after the first 2 years, straight line actually gives bigger deductions. Now the MACRS tables are where we find the percentages. I've been mentioning them. You can see here under the half-year convention, the first year is 20%, the second year is 32%, the third year is 19.2%, the fourth and fifth years are the same, and then the sixth year is half of the fifth year. So whenever you are figuring depreciation, if you know the formula, it makes it simple. You just figure out the formula on a piece of paper, and you can figure out what the depreciation is. If you don't want to do it that way, you can open up 946 and find the multiplication factor in the table. Now you can see that for 5-year property, we've got depreciation being claimed over 6 years, and the half-year convention representing this column. But if you have an asset that was placed in service under the mid-quarter convention, now we have to have 4 columns. And the percentage rate you get to use is going to vary depending on which quarter that that asset was placed in service. The second table in here is for 7-year property. I'm only showing you the first 6 years of depreciation percentages just to keep the space down. But of course the 7-year MACRS table would go for 8 years, wouldn't it? So we have the first year of depreciation for 7-year property being 14.29% under the half-year convention, and the mid-quarter convention is going to give you different percentages. And then by the time we're in the 6th year, we're at 8.92% under the half-year convention. For 15-year property, we're now going to be using 150% declining balance rather than 200% declining balance. So these numbers come out differently, and just to see where those come from, let me put up another pod here just so we can see what's going on with 150% declining balance and how it varies. So under 200% declining balance, you would take the cost of an asset times 20%, right? That's 200% if it was 5-year property. Let me make this better. I'm going to do the formula. We'll do a fence because that's 15-year property. So a fence costing $15,000 over 15 years, that would, you'd think, give you $1,000 a year straight line, wouldn't it? So over 15 years equals $1,000 if you're going straight line. But in the first year, you're going to have to apply the half-year convention. So you're going to multiply that by 50%. So in the first year, you're only going to be allowed $500 on that fence. And if you were going straight line, that would be your deduction. But if you're going to apply 150% declining balance, you're going to take that $500 and multiply it by 150%. And when you do that, you get $750. So let's just see what happens if I go up to the first item here under 150% declining balance in the first year. And if I take $15,000 and multiply that by 0.05, oddly enough, I get $750. That's always a relief to me because I'm never quite sure whether my numbers are going to work out. As I told you, I'm not instinctively good at this, but I have just done it on my handy-dandy calculator, and I did get the same result, $750. So that's how the 150% declining balance works. Most of the time when we're dealing with MACRS assets placed in service by your typical small business, they're going to be applying double declining balance, 200% declining balance, unless you're working with a farmer. And all farmers have to use 150% declining balance, even on assets that would normally be 200% declining balance property. But by the time you hit 15-year property, you're not eligible to use 200% declining balance anymore, and you have to use 150% declining balance. So that's how that particular formula works and differs from 200%. Now we're on to 27.5-year property. And again, I've only gone for the first 6 years on this. You'll observe that it's pretty consistent. In the first year, if you place that asset in service in the first month, it means that you're getting 11.5 months of depreciation. And if you place it in service in the second month, you're getting 10.5 months of depreciation. And so if you were to do the formula through and did a percentage, that's where these come from. But you'll see that every year after the first year, the depreciation is exactly the same, regardless of which month you placed that asset in service. And the 27.5-year table would actually go out for 28 years. And I've only put the first 6 years in here, but this 3.636 is consistent all the way across until the very last year. And in the very last year, you're going to have the reverse of these numbers. So we're at the top of the hour again and definitely due for a break. When we come back from break, we're going to take a look at a depreciation schedule. And since we're at the start of a break, and I never like to let people just sit around and do nothing during a break, why don't we flip to the back of your handbook, and during the break you can work on one of the classwork assignments that I put in here. It's not going to be classwork assignment number 1. If we have time for that, I'll come back to it. But go to classwork assignment number 2, which is on page 68. And in here we have a character named Nina Pera. She has purchased a residential rental property located in London, England. She has the following assets to depreciate for 2012. Complete her Form 4562 is what it says. I'm not going to ask you to complete the 4562, but what I would like you to do for her is figure out the amount of depreciation deduction she can claim for each of the 2 assets shown here, and I'll have the answer ready. Alberta, A-L-B-E-R-T-A, Alberta. So right off the bat, I'll tell you what the correct answer is. For the rental townhouse, the correct answer is $1,116. And for the washing machine, the correct answer is $37. So let's see where the computations come from that we figure those amounts. So for the rental house, the first thing we have to pay attention to is, remember at the start of class I said if you have property outside of the United States, you cannot use MACRS depreciation class lives. You have to use ADS class lives. And for foreign rental property or foreign real estate, the class life is going to be 40 years. And for all other assets, it's 12 years. So we have 12 years on the washing machine and 40 years on the rental property. And of course, on the rental property, we have to subtract out that $37,000 of land value. So we're going to go $100,000 minus $37,000. And then we're going to go over 40 years, divided by 12 months times how many months was it in service for that first year. Well, it's placed in service in April. That means we get half of April and all of the remaining 8 months of the year, so that's 8.5. And when we do that formula out, then we get $1,116. And for the washing machine, we're going to have $899. It's going to be divided by 12 years, which is then going to be multiplied by 50%. So that's actually the easier of the two, as long as you remember that it's 12-year property. And so the correct answer that you get from that formula is $37. So moving back in our manual to where we left off. Now we're going to talk about the depreciation schedule. So when you fill out a tax return and you're claiming depreciation deductions for an asset that was placed in service during the year, you have to attach the Form 4562. And Form 4562 actually has lines where you can enter the class life of assets placed in service and the amount of deduction you're claiming for them, as well as the cost of those assets. But if you're claiming a depreciation deduction for an asset placed in service in an earlier year, and if we're talking 2012 law, then an earlier year would be any year before 2012, that the asset was first placed into business use. And if you're claiming a deduction for assets placed in service in earlier years, there's no figuring that is ever entered on the Form 4562 to show how you're figuring your deductions for those assets. All of that figuring is done separately, either manually, the way I've been doing it with you in class, or through your computer software. And when you finally arrive at your net deduction, you're supposed to keep a record of that figuring on something called a depreciation schedule. And thankfully, in the days of computers, we don't really have to do much of this manual work. Our software just tracks all of those numbers for us and fills out the depreciation schedule for us. But in the olden days, tax preparers were expected to figure and keep depreciation schedules by hand. So you can see how big a favor computers have done for us there. Especially with my mathematical ineptitudes, I'm sure I'd have too many errors. So Form 4562, Depreciation and Amortization, is the form that is used to report and claim depreciation and amortization deductions for business use property. The form provides space to report current year depreciation on MACRS assets. It also provides space to report a variety of other depreciation and amortization deductions. However, Form 4562 is not used to figure or track the depreciation deduction on specific assets. Instead, you should keep a separate depreciation schedule. A depreciation schedule is a document that tracks information for each asset that is or has been subject to depreciation or amortization in the current year and in earlier years. Prepare and keep a depreciation schedule to track the following information for each piece of property used in your business. We begin with the cost. Obviously, the depreciation schedule has to track the cost, but you also, on that schedule, need to record the date that the asset was placed in service, the depreciation system, ADS or GDS, the depreciation method, straight line or accelerated, the class life that you've determined using the class life tables, the recovery period may be different than or equal than the class life, the convention, is it mid-month, half-year, or mid-quarter, the current year depreciation deduction that you have figured, the prior depreciation that has been claimed to that point, accumulated depreciation, which is prior plus current year depreciation, current and prior Section 179 deduction, current and prior bonus depreciation, and alternative minimum tax depreciation. That's a lot of information. Thank goodness our computer's doing it for us. Now, you need to keep a depreciation schedule to figure the amount and type of depreciation that you will ultimately carry to and enter on Form 4562. Do not submit the depreciation schedule with your tax return. The IRS does not want it. But if they audit you, they will want to see it. So it's a good idea to keep it handy for a long time, at least the life of all of the assets used in your business. So here on the depreciation schedule, this is a summary of the depreciation schedule that is created in the tax software we use called Drake software. So if we post or patch a depreciation schedule into answer keys for any of our courses, we're typically putting one in there that comes from Drake. And Drake arranges things with the description of the asset, the date, the cost, the salvage value. Salvage value is really an obsolete term. It applies to 1981 and earlier years where typically you had to arrive at a salvage value and you could not depreciate that. These days, tax software may have land value in here. It just happens to be that Drake software has a space for salvage value, but it doesn't ever list land value. So if you see any of our assignments where we've listed salvage, that is what we are using to enter land. But technically speaking, land, most of the time, will end up on a separate line of the schedule. But if you're looking at any of our work, our answer keys, and you see salvage value next to real estate, we're really referring to the land value. The business use percentage is important. That's what percentage of the use of that asset is applicable to business and what a percentage is therefore not business. Special allowance, that's whether or not you claimed bonus depreciation or the special depreciation allowance. Those are different words for the same thing. Section 179 deduction, the basis for depreciation, the life of the asset, the method or convention, the rate, that would be the rate that you pulled from the tables. A 5-year asset in the first year would be 20%. Current depreciation, prior Section 179 deduction claimed in earlier years, accumulated depreciation, and then finally, is there any difference under the alternative minimum tax? Briefly, I'm going to describe Form 4562, and we're going to be kind of floating through it as we go through parts of our lecture today, but near the end, I'm going to actually take a real close look at Form 4562 in detail. But for now, I'm just going to describe the form, and then as you'll see, we're going to be making a few illustrations that utilize Form 4562. as we go through the course. Now, except as otherwise noted, you should complete and file Form 4562 if you are claiming any of the following: depreciation for property placed in service during 2012 tax year, a Section 179 expense deduction which may include a carryover from an earlier year, depreciation on any vehicle or other listed property regardless of when it was placed in service, depreciation for any vehicle reported on a form other than Schedule C, profit and loss from business, or Schedule CEZ, net profit or loss from business. Any depreciation on a corporate income tax return other than Form 1120-S, and amortization costs that began during the 2012 tax year. So in essence, anytime you claim depreciation, Form 4562 is required. And the only exception to that is if you have a business that had no new assets placed in service during the year and that business is filing Schedule C, then it can just keep a depreciation schedule and put the calculated depreciation directly onto the Schedule C. But if the small business that is filing Schedule C has any listed property, then 4562 is required. And you might be asking yourself, what's listed property? It's coming. I'll explain that to you. Now, you should file a separate Form 4562 for each business activity for which Form 4562 is required. If you need more space, attach additional schedules. However, you should only ever complete one Part 1 in its entirety when you are computing the Section 179 deduction. So we're going to start really kind of the middle of the first page of Form 4562. I'm not showing you the entire form here. I do have the entire form in the manual on one page. Maybe I should just show it to you real quick, put things in perspective. Yeah, it's on page 58. So I want to bounce over to page 58 real quick. So later in the class today, we're going to look at the Form 4562 and take it line by line in terms of the instructions for it. Part 1 is where you claim an election under Section 179 to claim an expense on your assets rather than depreciating them. Part 2 is where you claim bonus depreciation and certain other types of depreciation. Part 3 is where you figure your MACRS depreciation deduction. And Part 4 is where you total everything up. On page 2, now we have space for something called listed property, and we also have space to enter all kinds of snoopy, nosy information about your vehicles that you used in your business. And in Section C, it asks for information for employers who provide vehicles for use by their employees. And then almost as an afterthought, at the very, very bottom of the second page, it says amortization. But for now, I'm going to be looking at certain parts of Form 4562 as they tie into a depreciation concept I am trying to teach you. And the first thing I'm going to be teaching you is about MACRS depreciation. So we're going to be focusing on Part 3, and we're also going to talk a little bit about Part 2. So let's go back to page 23 where I left off. Figuring and claiming MACRS depreciation, which is done in Part 3. You claim MACRS depreciation by completing Part 3 of Form 4562 as follows. You complete Section A, which is the green section up here, for depreciation deductions on assets that you placed in service in earlier years. And you'll see it says, line 17, MACRS deductions for assets placed in service in tax years beginning before 2012. And then in Section B, you complete Part B or Part C down below to figure depreciation and amortization for the year on assets that were placed in service during the current year, that is 2012. So line 17 is for depreciation on all assets placed in service in earlier years, and line 19 is for MACRS assets placed in service during 2012. And you can see it provides space for some of the same information that we were entering onto the depreciation schedule. Remember, on the depreciation schedule, it asks for the month and year placed in service. Well, on the 4562, that's all grayed out because we're going to apply a convention. And the year or month we placed it in service isn't so relevant for most of the property, except when you get down to residential rental and non-residential real property. Then it allows you to enter the month and year placed in service, because then you would be applying the mid-year convention. And in those cases, it actually fills in the useful life or the recovery period of that property for you, and then tells you that the convention is mid-month and the method is straight line. But for these other assets, for 3-year property, the basis for depreciation, you manually enter that for all 3-year property placed in service during the year. The recovery period would typically be 3 years, correct? The convention is probably going to be half year, but it might be mid-quarter. And then the method is either going to be straight line, 200% declining balance, or 150% declining balance. And then finally you figure out what the depreciation deduction is and you enter it on the form. You are going to use the classification tables and Appendix B of IRS Publication 946 to determine the class life of the property you are depreciating. And then on line 19 of Part 3 of Form 4562, you're going to enter the total cost of all MACRS assets property placed in service during the current year in column C. So if I purchased a computer, and I purchased a printer, and I purchased a photocopier that are all peripherals, and the computer cost $2,000, and the photocopier cost $12,000, and the printer cost $1,000. I'm going to total all of the cost of all of those assets up together and enter them as a lump number on line 19B. So it's not interested in the individual cost of each of those assets. It wants the total of the cost of all of those assets entered on line 19B because they all belong to the same class. Special depreciation allowance is the next thing that we're going to talk about. You might have heard me call that bonus depreciation. Special depreciation or bonus depreciation allows a business to claim additional depreciation deductions for qualified property placed in service in certain years. Bonus depreciation was first introduced to stimulate investments in new equipment by businesses during the economic recession that followed the September 11, 2001 terrorist attacks by allowing businesses to claim 30% or 50% of the cost of assets placed in service during the year. Bonus depreciation expired for most property placed in service after 2004 and was not available for most filers for tax years 2005, 6, or 7. And just as we were at a point where I didn't think I would have to teach bonus anymore, then it came back. We hit another recession, and the first thing that happened was our politicians decided, well, it was time to bring back bonus depreciation. Give businesses an incentive to purchase, keep industry churning, give them some write-offs for buying these items. So people that might have been conserving their cash, here's an incentive to spend cash and get a big write-off for doing it. And while they're spending that cash, maybe they're helping to stimulate the economy a little. So that was the rationale going on when it was reintroduced in 2008 and 9. Now, that wasn't good enough. The economy still wasn't catching up as quickly as people wanted, and so the Small Business Jobs Act of 2010 changed things again. And that act took effect beginning September 8. So for investments placed in service after September 8, 2010, bonus depreciation increased to 100%. So for the rest of 2010, of all of 2011, we had 100% bonus depreciation in play. Then for tax year 2012 and 2013, we are back to 50% bonus depreciation. So what kind of property qualifies for that special bonus 50% depreciation? The type of property that generally qualifies for special bonus depreciation includes MACRS assets with an assigned recovery period of 20 years or less, computer software that is not a Section 197 intangible, qualified leasehold improvements to non-residential real property. To be eligible, the property must be qualified reuse and recycling property, qualified cellulosic biofuel plant property, qualified disaster assistance property, certain qualified property placed in service after December 31, 2007, or certain qualified property acquired after September 8, 2010 and placed in service before January 1, 2013. The special depreciation allowance does not apply to the alternative depreciation system, ADS, if it is required to be used. However, if you elect into ADS, optionally, not because you're required to, but you just decide to elect into it, then the 50% and 100% allowances are still allowed. Certain qualified property acquired after September 8, 2010 and before 2012, you can take a 100% special depreciation allowance for certain property acquired between those dates. Your property is qualified property if it meets the following requirements. It is one of the following types again. Tangible property, depreciated under MACRS with a recovery period of 20 years or less. Water utility property. Computer software that is available for purchase by the general public. That's just off-the-shelf software. And qualified leasehold improvement property as well. You must have acquired the property by purchase after September 8, 2010 with no binding written contract for the acquisition of that property that was in effect before September 9, 2010. If you entered into a binding contract after September 8, 2010 and before January 1, 2012 to acquire that product, including to manufacture, construct, or produce certain property with a long production period or certain aircraft, then that property will be treated as timely acquired. So what it's saying is there was a unique period in time there between September 8, 2010 and December 31, 2011 where you could get 100% bonus depreciation by buying an asset. But certain assets that you might order, it may not have been possible to deliver those assets and place them in service within that short time frame. And so if you placed an order during the time frame for an item that has a long production period like an airplane, then as long as that property is placed in service before the end of 2012, then you can still claim 100% bonus depreciation. So although a bonus depreciation of 100% does not apply to 2012, certain long production products would get 100% depreciation in 2012 if they were those long production type assets. But other than that, there's no 100% bonus in 2012. Now, your original use of the property must begin with you after September 8, 2010. It cannot be accepted property. And for a list of accepted property, you can go to Publication 946 and look at page 25. Certain qualified property acquired after December 31, 2007. You can take a 50% special depreciation allowance deduction for certain qualified property acquired after December 31, 2007. Your property is qualified property if it meets the following requirements. It is one of the following types of property. Again, we're back to tangible property depreciated under MACRS with a recovery period of 20 years or less, or water utility property, or computer software that is off-the-shelf software, or qualified leasehold improvement property. You must have acquired the property after December 31, 2007, and you must not have had a binding contract to purchase that property before 2008. Because the idea behind this law was that it was inspiring you to spend more money that you had already committed to. And as we entered the deep, dark recession in 2008, that was when the government was trying to inspire people to spend. And if they had already made a commitment to spend, they weren't going to get the deduction, at least if they made the commitment before 2008. The property must be placed in service for use in your business or for the production of income before January 1, 2014, and you get an extra year all the way out to the end of 2014 if you purchase certain property with a long production period, such as aircraft. The original use of the property must begin after 2007. It cannot be accepted property. So let's look at qualified leasehold improvement property, because qualified leasehold improvement property is property that qualifies for a 15-year life, but it can also qualify for bonus depreciation. And it can also qualify in certain cases for a Section 179 deduction. So let's take a look at what qualified leasehold and property is. Qualified leasehold improvement property generally includes any property to an interior part of a building that is non-residential real property, if all of the following requirements are met. The improvement is made by a lessee or tenant. The part of the building being improved is to be occupied exclusively by the lessee or any sublessee. The improvement is placed in service more than 3 years after the date the building was first placed in service by any person, and the improvement is Section 1250 property. So let's just say you are a tenant, you signed a 10-year lease on a commercial building, maybe for a retail establishment. And you go in there and you have to do a lot of finish work to the interior. You need to put in systems. You're spending a lot of money. And you're the tenant and you're the one spending that money. You will be allowed, under the rules in play for 2012, to treat all of those improvements as 15-year property, even though they are structural improvements to 39-year property. But it only works that way if you're the tenant making the improvements. If you're physically the owner of the commercial building and you're making the leasehold improvements, then you wouldn't qualify for that shorter life. It would be 39-year property. Now, there's a certain kind of property that does not qualify as 15-year property, and it includes the enlargement of the building, an elevator or escalator being installed in the building, any structural component that benefits a common area of the building, the internal structural framework of the building, and property leased to a related person. Related persons. For this purpose, the following people are related: members of an affiliated group, an individual and any member of his family, including only a spouse, child, parent, brother, sister, half-brother, half-sister, ancestor, and any lineal descendant. a corporation, and an individual who directly or indirectly owns 80% or more of the value of the outstanding stock of that corporation. 2 corporations that are members of the same controlled group. A trust fiduciary and a corporation if 80% or more of the value of the outstanding stock is directly or indirectly owned by or for the trust or grantor of the trust. The grantor and the fiduciary and beneficiary of any trust. The fiduciaries of 2 different trusts and the fiduciaries and beneficiaries of 2 different trusts if the same person is the grantor of both. A tax-exempt educational or charitable organization and any person, or if that person is an individual, a member of that person's family, who directly or indirectly controls that tax-exempt organization. 2 S corporations and an S corporation and a regular corporation if the same person owns 80% or more of the value of the stock in each. A corporation and a partnership if the same persons own both of the following: 80% or more of the value of the outstanding stock in the corporation, or 80% or more of the capital or profit interest in the partnership, and finally the executor and beneficiary of any estate. So in other words, if any of the following own the property that you're making that leasehold improvement to, then it won't be considered to be 15-year property, it'll be considered to be 39-year property. Making the election not to use bonus. So you might understand that maybe a company doesn't want to claim 50% bonus or 100% bonus on assets placed in service during the year. You can elect out of the special depreciation allowance if you don't want to take it with respect to any class of property. This means the 50% or 100% allowance is automatic for years where it is allowed. So if you don't file a timely return, let's just suppose you've got a client who comes to you in 2013 and they're now ready to file their 2011 business return. Well, in 2013, there's no way around it. 2011 is late, it's really late. And because it's late, if that business placed any assets in service during the year, it's forced to claim 100% depreciation on them. There's no way to elect out and do any other method of depreciation. If you are filing a timely return, it is only with the timely return that you can elect out of bonus. And so for that reason, tax software will default to claiming 100% or 50% bonus depreciation in the year the asset is placed in service, because that's the default. And you're going to have to deliberately make a decision in how you do your data entry in the computer to make it MACRS double declining balance or straight line, any other method you might choose. So the election not to claim the special depreciation allowance applies to all property in a single asset class placed in service during the tax year. If you elect out of the special depreciation allowance for one asset in a class, you must do so for all assets in that same class. However, properties in different classes can still be used for the allowance. To make an election, to attach a statement to your timely filed return, including extensions, indicating the class or classes of property for which you are making the election, and that for each asset in these classes, you are not claiming any special depreciation allowance. The election must be made separately by each person who owns qualified property, for example, by the partnership, by the S corporation, or by the common parent of the consolidated group. If you timely file your return without making the election, you can still make the election by filing an amended return within 6 months of the due date of the return, including extensions. Right, filed pursuant to Section 301.9100-2 on the amended return. Once you make the election to not claim bonus, it cannot be revoked without the consent of the IRS. If you elect out of the 100% special depreciation allowance for property acquired after September 8, 2010 and before January 1, 2013, the property does not qualify for the 50% depreciation allowance. Now, the reason I've gone out of my way to say that is because back in the earlier bonus depreciation systems we had in place under the Bush administration, that is for post 9/11 through 2004, when that system for bonus depreciation was first introduced, it provided for 30% bonus. And then after that, it was increased to 50% bonus. And for the period of 2003 and 4, when 50% bonus depreciation was in play, you could elect out of 50 and claim 30 instead. But that's not possible today. Now, today when we're looking at a year where you're eligible for 50% bonus depreciation or possibly, in a few situations, 100% bonus depreciation, if you elect out of 50, you don't get 30. If you elect out of 100, you don't get 50. You elect out of bonus completely. So figuring the special depreciation deduction. To determine the amount of your special depreciation deduction, multiply the cost of the qualifying property by 50%. Figure the allowance after you figure the Section 179 deduction, but before you figure your regular depreciation. Note that 30% depreciation deductions may apply to years 2001 through 2004, and 100% depreciation applies to 2010. So here's some illustrations of how 50% bonus works. On September 3, 2012, you bought a computer network for your business that cost $50,000. You did not elect to claim the Section 179 deduction. Calculate your special 50% depreciation allowance as follows. Multiply the cost of the network by 50%. That's $50,000 times 50% is $25,000. Your special depreciation allowance will therefore be $25,000. The remaining $25,000 cost of the network is depreciated using 5-year MACRS. Example number 2. The 50% bonus depreciation is combined with the Section 179 deduction. Assume the same facts as above, except that you decided to claim $20,000 as a Section 179 deduction. You then figure your special 50% deduction as follows. Reduce your depreciable basis in the network to $30,000. You're going to take 50 minus the $20,000 you're claiming under Section 179, and then you're going to multiply the difference, which is $30,000, by 50%, and that gives you your special bonus depreciation deduction of $15,000. Then the remaining $15,000 cost of the network would be depreciated using 5-year MACRS. So how do you claim bonus depreciation? Figure the amount of bonus you are claiming by completing a depreciation schedule for qualified property placed in service during the year. Enter the amount of bonus depreciation you are claiming for the year on Form 4562 in Part 2 on line 14. And Part 2 appears immediately above the part where you figure your MACRS depreciation deduction and immediately below where you figure the Section 179 deduction on the form. So line 14 is where you enter your deduction. So here is an illustration where we've got a couple of different assets placed in service at the same time. Tiffany Banner purchased and placed the following property in service in her business in 2012. Office furniture costing $10,000 and a computer-based IP telephone system costing $20,000. The total cost of the assets placed in service during the year is $30,000. Office furniture is 7-year property. The computer-based phone system is 5-year property. We can see that based on the dates placed in service, we do not have a situation where more than 40% of the assets placed in service during the year were placed in service in the final quarter. That's not the case. Therefore, the half-year convention is going to apply. So we're going to take $5,000, which is 50% of $10,000. We're going to take $10,000, which is 50% of $20,000. We add those two numbers and we get $15,000. $15,000 is the amount of bonus depreciation that Tiffany will claim on her return. She then does 200% declining balance under the half-year convention for the remaining cost of the assets. And when she does that, she gets $2,000 for the IP phone system, and she gets $715 for the office furniture. So she'll enter $15,000 on line 14. She will then reduce the basis of her assets by the amount of bonus that she's claimed. Therefore, she has $10,000 of 5-year property basis, and she has $5,000 of 7-year property basis. She applies the recovery period, the convention, the method, and the deduction. Grand Teton. G-R-A-N-D-T-E-T-O-N. Grand Teton.